folks, Scott here, and this is the wrap for Monday, September 23rd. So, sort of an interesting day today. This was, I think, a fairly important day for the Bulls and the Bears in that with Friday's week action, it certainly brought into question whether or not the Fed reaction, the continued quantitative easing, was simply a fake-out short covering rally. And because we had held it right where we closed right here. This is a 5-minute chart all scrunched together. But today we traded back down into Wednesday's action and actually closed below where Wednesday had closed and where Tuesday had closed, right at where Monday had closed. So I wouldn't say it's game over yet, but it's getting dangerous. We are testing also, if you look at 10-day moving average, we're right at it. So might get a bounce there. But what I thought would be helpful would be to show you the results of fading gaps after a 5-day low close. This is the lowest close of the past 5 days. This is 1 day, 2 day, 3 day, 4 day, and 5 day. But not a 10-day low close, which was somewhere over here, right? So 5-day low close, not a 10-day low close, went above the 200-day moving average. I'll use Gap Trader, my back testing tool, which I'll talk about a bit more in a moment. And there you go. That's any day of the week. It does not pay attention to the 10-day moving average because we closed right at it. Good sample size, and two things stand out. One, odds favor a gap up almost 2-to-1 on a good sample size, right? About 90 trades versus 50. So significantly greater chance of gapping up than down tomorrow. And a gap up using an end of the day stop has just been a dead neutral scenario. Not bad, not good. Whereas a gap down has been historically above average in terms of almost a 10% higher win rate than the typical gap, certainly 5 or 6% at a minimum, and it's made 50% more in profits and losses. That is I would call that a very clear long bias. Now, I will rerun these numbers for our members in the morning to confirm how tradable a down gap may be, because sometimes you will see really strong numbers like this, but the gap fill win rate using our MTG stock parameters would be low, because it just tends to be accompanied by too much post-open volatility. That's one of the benefits, I guess, of membership. But I'll rerun that, double check it for our members, and share that with them in the morning in my pre-market comments. All right. See, today ended up gapping down. In fact, this is as good a chart as any. I take that back. Get rid of the 5-minute chart. If you look at the white line is where we opened today in each of these markets. This is the S&P futures, the Russell futures. The NASDAQ futures gapped way up. The blue line is the prior to low, so that was a big gap up. And then the Dow futures gap below its low. So the Dow, the S&P both gapped down below their blue lines and below their red lines. That means they're opening in the DL zone. So small gaps down below the low of a prior down day. And the exception was the NASDAQ, which opened up in a very high probability gap fill setup DOC zone. And let's see, the Russell looks like barely a gap. So let me show you my how I interpreted the data today. It was a little bit tricky. Oops. And sorry about that. One thing before I show you our data, there's a free webinar on Wednesday, live demo of two powerful trading tools, MTG Gap Trader and MTG Range Trader. So if you're even remotely interested in systematic trading, we talked about it at length, comparing systematic trading and probability trading versus discretionary trading last Thursday, then definitely join us for this free event. We'll share some good information, and we're sharing a special offer trying to book our training sessions. Or we do a lot of one-on-one training with these events and try to book them next 2 to 3 months in advance. So if you're interested, now's the time to buy, and we'll make it worth your while to join us on Wednesday. All right, let's see. The worksheet showed over the weekend the following. For indices on average opening below the prior lows, it was a little bit of a tricky setup. Only about a 50-50 win rates, made a little bit of money. Now if we open between the close and low, which was a small window, it was a very attractive setup, and gapping up was sort of a neutral setup. Monday post options expiration showed odds of gapping down day. Quite frankly, that was one of the reasons I didn't go long based upon some strong overnight data. See, that's a 59% chance versus only 41 for gapping up versus down. But being Mondays, I tend to be more cautious because you got all the pent up weekend demand that can add some volatility, and this number confused me, not confused, but concerned me a little bit. Show you the indices were gapping. I'll show you the gap guys real quickly. I'm not going to show the range guys today because just nothing set up well. So good setup in the DCL zone and good in the DL zone. YM neutral and actually looked a little bit better in the DL zone. Nasdaq was gapping up in the high probability DOC zone, right, defined by these two ranges there, and the Russell wasn't much of a gap. It was in the high probability DCL zone. Looking at the ETFs, the DL zone was confirmed as being an attractive setup today for the spider. Diamonds right at my criteria there as well. Qs confirmed what the Nasdaq future showed, decent setup for shorting. Their up gaps, and then the Russell again was small. So here's what I wrote in my pre-market comments, because it was a little bit tricky. I trade the ES primarily, but I don't like to go against the other markets, and today was a good example of that. You know, if it's just a small gap, the Nasdaq gapping up just a little bit, I'm okay with that. But today, that large gap really caused problems for the S&P. So there was some more data that was mixed for fading gaps on Mondays. Did not favor shorting up gaps, slightly favored down gaps. It was right at my minimum criteria. Small to mid-sized down gaps in the DL zone during similar market conditions historically have been neutral, but going for the extended target made them profitable. So overall, the gap guys are showing slightly positive setups for down gaps in the DCL zone, neutral for DL zone. It just wasn't strong enough overall. And we had mixed data to boot, so I said, though the DL zone does not look terrible, yes, it's are both supportive, and that's the most important industry index. That's why I made that comment. I will only fade the ES half-size position if it opens in the DCL zone with at least a point of opportunity. So it only ended up being a 2-tick window of opportunity. And some people say, why bother? And my argument would be, well, why not? Right? I mean, we're trying to make money, so you want to take all the setups. We can't control what the market does, but we want to take all the ones that meet our criteria. And this would have met my criteria. And I was going to hold some. I was actually going to hold half the position for extended target. I was going to trade it aggressively. So that was my plan. And the ES did rally a little bit into the open, but not enough. And it triggers probably hard to read 1700.5. It's about a point too small. I passed on it. Some folks took it because they thought it was decent. It was we were stretched to the downside, and it was they got buffaloed. Market, or some did, went up to 1702 and a quarter, 2 ticks below the prior close. So technically today was an unfilled down gap. That'll show up on the worksheet tomorrow. I won't give it a lot of weight though, because the other indices all fill. Now here's what I meant about the Nasdaq. Pretty rare. This was Apple driven. With their mobile phone sales with their new phone over the weekend, resulted in a big pop up. This is a great example of fading the news is often a decent thing to do. It just because the Apple was not, I mean the Nasdaq nor Apple, those stocks were not really being supported by the overall price action. Financials were down and many sectors were down. So it was a good favorable opportunity. I did not trade it, nor am I inclined to do that. But the risk you have on these small gaps is if the big Nasdaq gap starts filling its gap, it's going to put downward pressure on the S&P in a zone that was already weaker than I like to trade. So and you can see it played out today. See how the Nasdaq, the Nasdaq sold off to about 11. Guess when the ES bottomed? 11. Guess when the Russell bottomed? 11. Guess when the Dow bottomed? 11. That's why I pay attention to these markets. All highly correlated, and it's going to be hard for one market to do its own thing without conforming somewhat to the others. So it was a good decision not to fade it. I would have been stopped out, so I avoided a loser. And the 15-minute and first hour range guides were not very attractive, so I did not do any other trades. And that was my day. So there you go. That is the wrap for Monday, September 23rd. Have a good night.